Luncheon. Thank you so much. Thank you so much for coming, and we are very, very happy to host you this afternoon, and very happy to have our amazing panel. So the topic for today is the art and science of fundraising, because as we know, fundraising can be the science with all the metrics, performances, and also art with storytelling and all the background and why we're doing everything. So today we have Rob, Amit, and Andrew. If you could, guys, introduce yourself briefly, what you invest in, how big is the fund, and what's your focus right now?
Yeah, so Rob Kniaz, I started a fund called Hoxton Ventures here in London 3 funds ago, and now the spin-off fund called H3 Capital, more deep tech focused, historically very generalist, but always kind of seed and Series A across Europe.
Hi, I'm Amit Zutshi. I'm not based in London, I'm based in Dubai. We invest in deep tech and fintech, B2B tech, around Series A, pre-series, Series A kind of stage on the India-US axis.
Andrew Scott, based in London and Lisbon, founder turned investor of just over 10 years now. Started a fund called 7% Ventures, just raising our fund £300 million fund now, do early stage, deep tech, and sort of transformative startups, pre-seed and seed.
Okay, amazing. So my first question is, what is the biggest challenge you've seen while fundraising? I'm sure there are many of them, but the biggest one. Rob?
There's so many different facets of that to go on. I think.
I know, yeah. Just where do we start?
I guess for the stage of the fund, mapping to the right kind of LPs for that fund. So if it's a fund one, you need people that take more risk on versus institutional. If it's a later fund, you kind of switch gears to more institutional investors. I think finding the right people at the right time is hard. It's quite a, we'll meet tons of people, different intros here and there, and kind of filtering and focusing is one of the big challenges to manage your time.
I was going to say filtering, yes, because it's very easy to go across the world to try and find pockets of capital. But sometimes the capital comes from the most unusual places, which are not part of your strategy. So there has to be an element of just spreading your message, but just focusing in on those few dozen people where the capital is most likely to come out of. Getting to that is probably the hardest thing we've had to do.
Yeah, I'd agree with that. I mean, I think it's very much like a startup with a VC, matching yourself to the capital you're trying to secure. And as VCs, I think often we think we're selling track record and strategy, but actually I think we're selling access, reputation, and differentiation. So I think we all like to think as VCs we make data-driven decisions. I would sort of counter that. I think often I think humans are emotional. I think LPs are the same, and so I think they often make quite emotional decisions and sort of backfill that with data. So I think when you're thinking about just because you've got exceptional track record doesn't mean you're automatically going to get a ticket. And I think that sometimes we can hang ourselves. Those things need to be in place. You need good enough numbers, and you need a good enough strategy and thesis. But actually, it's often a lot of other things that tip the money into the fund.
So it's more arts using that science.
I think it's both, but I think there's a lot. One thing I've learned over the last 10 years, it's a lot more art than science. Yeah.
Can I just add to that by saying that we've had our tribulations with being very scientific about how we went about doing our fundraising, and taking analytics and explaining the science behind our investment decisions, our sourcing engine, investment thesis, our numbers, metrics, performance, blah blah. And the vast majority of the time when we tried to do that in the past, we lose the LP. Even if the numbers are looking great. So there is something more than that, and a good part of it, especially in the current environment, is about just connecting on a human level.
The story is you're a market vendor selling something, and you have a really good story about it. That's all that matters. Not the data necessarily. Track record helps, but it's that captivation of the story that really gets people excited.
Yeah.
Well, that's what we are trying to do at VNTR, build relationships. Yes. And so you mentioned differentiation. Yes, I'm sure most of the LPs hear that we are the best VC, backing the best founders. How do you differentiate yourself among all the VCs?
I think it's useful to be. Let me reset. So I think, rightly or wrongly, and I'm sure there are plenty of funds that have raised successfully not doing this, I think you need to have true conviction on your thesis. So my thesis, the fund size, how we invest, what we invest in, who we invest in, is because I truly believe that it's going to be most successful for our startups and most successful for our fund and our returns, rather than playing to the market. And again, this echoes the same as founders. Founders often make the mistake of trying to respond to what they think investors want, and I think it's a fool's errand. You just sort of chase the tail of the donkey, go round and round. And so that means automatically that when I pitch to some LPs, I risk immediately discounting myself because I've said the wrong thing. My portfolio is. I remember pitching to Horsley Bridge once, and we went through the whole pitch. I said, "How do you think we've done?" And she said, "Oh, we're not investing." I was like, "Oh right, can I ask why?" She said, "Oh, we've never invested in a fund with this, with 50 companies in the portfolio." I was like, "Well, why am I here?" They said, "Well, you just thought it was interesting what you were doing." So I mean, it's you do risk that. And I think the conviction and the authority you have by being really true to yourself about your thesis is super important. I've already spoken to some people in this room who have approaches for investing that I wouldn't do. Maybe they take more of the company, or maybe they have a smaller portfolio size, and that's all fine. But yes, I think being really clear, and that actually helps you narrow down to people that then you do have a chance of securing money from.
I mean, for us, it's that's clearly important, right? The clarity on strategy, portfolio construction, and investment thesis and all of that. But then, having the execution capability, whatever that strategy is, to be able to put the pieces in place. So whether it's sourcing, the investment decision-making process, if there is any value add, what is that? Can you actually prove that? How do you think about creating liquidity for generating DPI, etc., etc. So all of those are obvious things that have become even more to the fore in the last 3 years. Right? It wasn't really the case for a couple of years before that. But I think there's also this element of when it's about for us specifically, because we invest in the India-US assets, and if I'm selling the fund here, in the UK, in continental Europe, for us, a big part of the differentiation is that the vast majority of the LPs here see opportunities from within Europe, and so that creates an obvious differentiation for us, right? So there is a small allocation you could do that is focused on India, the rise of India, and the connectivity between India and the US, etc., etc. So that allows us extra bit of differentiation on top of it.
I think the differentiation to me is a lot of LPs, like, what do you give them they don't have already? Like, for a lot of them, they can go direct and lots of deals. People are offering them tons of direct. What can you show them that's proprietary or unique, or why is your thesis interesting, something they're never going to see, whether it's people just graduating from university or whatever it might be, some edge that really convinces them, okay, this is something I'm not going to get by just plowing money into directs.
So when fundraising, like people say it's a numbers game, would you agree with that? And how long does it take for you to raise funds from one LP?
I'll let Rob go first.
I think it's a numbers and time game that I've had people go quiet for 7 months, then come back and they're ready to sign the next month. There's so many factors going on. Who knows? I think chase well in your CRM and manage them, but until they give you a hard no, there's still potentially yes. And yeah, I think I can't say anything better than just playing the numbers and luck and timing in a lot of cases.
Yeah, we've taken between a few weeks and more than a year. And there are still some conversations going on, which started 2 years ago. And there is a chance that a couple of them drop in the next few weeks. So it's, everybody has their own way of, building trust in the people that they're sitting across the table from. And it's important just to sort of keep in touch, keep them updated, and that.
Yeah, I think it definitely takes time. No question. It's very much a relationship game, much more than being a founder raising from a VC. But I think what is the same, which we tell a lot of our founders, is do your DD on the LP as well. Like, actually, it's a two-way conversation. And sometimes when you're sitting with somebody who can write you a £10 million, £20 million, anchor ticket, you forget because you go into sales mode. But actually drilling them on, how does your IC work? What is the process from here? When is the next, how many seats do you have available, in your mandate over the next year for new managers? Because most managers only do 1 or 2 a year, and they'll re-up and they'll re-up. Are you dropping any of your managers? Do you even have discretionary capital? That's a question I ask. Especially family offices, they're so opaque. So I think having that smorgasbord of lists of 10 questions that you ask, and you're not afraid to ask, and if they're evasive, there's probably a reason.
Yeah.
So I would, and it's a bit like, when founders drill us, right? We sort of, on the one hand, we're a bit asking all these fucking questions. Like, you sort of hate it, but you also respect them more as a CEO. So I think it's the same relationship with a manager and an LP. Like, just push. If they don't like it, then that's how they're hard enough. But you don't want to walk out of that meeting or off that call not knowing the answer to those basic questions of what capital they have available, how long does it take, when was the last time they did a fund like yours, how many people make the decision, who makes the decision, do they even have a space for a new manager, etc., etc. How many funds do you take to IC which get rejected?
And if you don't find out the answers to those questions in that first meeting, or maybe the second meeting sometimes, it must be the first meeting, then you will find them out when they say no. And they will all say no if you haven't asked them the questions.
Yeah.
So, how often do you get ghosting from LPs?
But it's funny because, like you said, Rob, like some people, I've had people go like quiet for literally.
Yeah, well, what is
5
wasting?
months.
They come
Yeah,
back
what
with
is
6 months
How
later.
long? How long? Yeah, like 5 months, and then I've just sent an email that has landed in some way. I think the answer is don't give up. You do have to be a bit comfortable, I think, with being a bit, I wouldn't say spammy, but bordering on discomfort of spamming. Like, make sure you're not literally spamming them, but do follow up, send something different. If that, portfolio update doesn't work, send them something else. I sent out as an experiment, I sent an email out using obviously a mail merge on Streak, so it looked like it was personal, but it wasn't, to about 30 LPs, just saying, and it was like, in London, drink 4 p.m. Like, it was, Thursday, and I thought, I'm just going to try this. I couldn't believe I got 4 responses of people I haven't heard of for 2 months. Probably all the people that don't drink ignored me, that's fine, but the ones that did drink, who want to drink, I got 4 responses. So you've just got to try and not be too, not be too careful.
I'd say exactly the same thing, and just try to, keep giving an update which piques their interest. And the more updates you have, that sort, make use of them.
Because people are just really disorganized, and their email goes into the ether after the first day when it scrolls out. So you just happen to have the one that lands when they're waking up at 10 a.m. They happen to see yours and it goes through, but the last 10 didn't go through.
They're getting pitched all the time by a million other people.
Yeah.
So how do you cut through that?
Yeah, a founder of ex-founder, well, friend and founder, who we backed, and then sold his company, and has now just joined his partner. Actually, he originally was in PE, went to startups, and then came to VC. And he was like, look, he went through the LP types, and he was like, okay, so investment bank or institutional is like, email them 8 a.m. Tuesday morning. Don't bother emailing other time, or maybe Monday morning, before the week starts, before it gets in. Otherwise, they email just before, they won't read it. There are sort of little tweaks you can do. I think.
What are the questions you usually ask LPs? You mentioned 10 questions. You don't have to tell all the 10 questions.
It covered a lot of them.
No, I mean it's obvious stuff like you start with simple things like what do you invest in? Is this an asset class that you actually have invested in? What kind of funds do you invest in? If you do invest in funds, what state, what geos, what geographies? What about directs or co-investments? And then you get into the questions around dry powder. Do you have dry powder? What does your process look like? What's your IC? It's a bunch of those things that you want to get some clarity on, because it's not just about trying to figure out if there is a possible fit here, but it's also about figuring out whether this is a conversation that's worth taking into 5, 6, 8, 12 months, or dropping it completely now. Because you can't be taking 500 conversations forward over a year.
Anything to add?
And then just mutual connections, mutual references. I mean, the best referrals are when they're from an existing GP in their portfolio.
Yeah.
So if you have some connection to them, or you know someone who knows them, they'll vouch for you. That's probably the single most action-inducing thing you could do. So you're trying to figure out where there's connections or where there's some kind of back channel.
I think that's true, especially with brand name sort of fund of funds, and the more the more well-known the fund is, or how better reputation is, you need a personal recommendation to get in. I remember years ago trying to get hold of what's her name? It's Lisa Edgar when she was still at Top Tier. Sent her an email. It's for Fund 2 or someone, I can't remember. Sent an email. She read it. I could see she read it, and no response. Followed up twice, no response, and then literally a month later got a personal intro. I sent exactly the same email. And she replied instantly, "Oh, it's so great! Sounds brilliant what you're doing. Would love to meet." It's like it's the same damn email. So it's social proof.
So when would you give up, like following up? Never.
I don't think it's ever a no. It's never a no till it's a no or a yes. I mean, I think your point around stack ranking the likelihood of someone investing, because you do need a lot of shots on goal. You do need to kiss a lot of frogs, and therefore you want to narrow the best odds of conversion. But outside of that, they all stay in my CRM until I hear a no.
Yeah, I mean, for emerging managers, and especially investing in early stage venture, it's largely family offices, HNIs, funds of funds sometimes. It's unlikely to be an institution. And there may be one or two, particularly if you have long-term relationships with them, but it's unlikely to be an institution. And in that case, if you do want to build relationships with institutions, because we are on our second one, but by the time you get to the third one, maybe you start to get some good quality institutions into the equation as well. So you want to build those relationships, keep them going, knowing that they're not coming into this one. But even among the HNIs and the family offices, you do come across all sorts of people, and you want to be careful about who you want to sort of spend your time working with.
And do you do, especially in deep tech, I believe, do you do a lot of, do you educate your LPs, or do you think it's not necessary?
You kind of have to up-level a little bit to make it more accessible to the less diligent, to the less technical. But you just have to make the story a lot more, what would someone want to read in the USA Today, or what would you say to a regular newspaper reader, that kind of level. You can translate that into something exciting, then you're in a good place.
I mean, I don't know what you guys think, but I've sort of over time got to a point where the first meeting, I used to try and educate a lot, and the less you say, the better it is, and you develop traction quicker, because you can cut through this the top 3 or 4 things that you want to say, tell them in a quick story up front, and then respond to questions, as opposed to tell them the whole 9 yards in the first 35 minutes, and get nowhere in that.
Yeah, I think that's great advice, actually, knowing when to shut up. Something I'm always not very good at. I think probably the biggest, just thinking about sort of learnings, the biggest mistake we made, which is frustrating because it's something we've been telling our startups for a while, is a general in business change, the level of importance of brand and optics in enterprise, and that moves into like fintech and funds as well. That's really shifted in the last 5 years. So the degree to which your brand presence, I don't know if you guys agree, but your brand presence and your you're being seen on LinkedIn and getting in front of people, and people just having that marketing presence in front of you, the degree to which a logo as a firm, as a VC firm, matters and influences your chance of raising, I think it's fundamentally shifted. Even in the last 5 years when I raised my fund too. And I sort of, when we talk to deep tech startup founders, one of the big differences between here and the US is that US founders, on the whole, intrinsically understand the power of mind share in the market, and before they even have a product to sell, ensuring they own the sort of the crown of being, we are the winner in this space, even before this space has become a huge thing. And that's something we spend a lot of our time telling UK and European founders, but I sort of didn't eat my own dog food. And so it was only about 18 months ago we really started pushing on our own marketing and actually pushing stuff out on LinkedIn, putting all our IP database into a targeted LinkedIn campaign, and actually making sure our stuff gets in front of those people. And it has actually worked. We've been really regular for the last year on monthly updates to all our target LP list of what's our portfolio doing. So someone sits for 3 hours, pulls together all the portfolio news, pushes it out, and that has actually resulted in traction with LPs we didn't have before, and even inbound. People say, and I bothered now to go on a podcast regularly. All this stuff I sort of feel is a bit BS, but that's just the way the world works now. It's so noisy out there, and with the ecosystem in the UK and Europe being so much busier and there's so many more funds, you've got to be seen. And so if you're it's still that old adage of like, you don't get fired for buying IBM. So if you're a brand name that people have heard of and seen, even if your performance isn't that great, it's not top decile, but you're in a fund of funds and you're employed, or you're employed by a family office and you back that fund that people have heard of, that feels less risky than a fund that might have great performance but nobody's ever heard of because they're really niche and they've got no website. Do you know what I mean? So that's definitely a big learning that you just have to invest.
That's such a good point, because by definition we're all entrepreneurs ourselves, right? Because we founded these firms and the funds and all of that. But the vast majority of people who are taking those decisions are not entrepreneurs.
Yeah, that's good.
Right? So they are, whether it's a fund of funds, employees, CIO, etc., who's getting a salary on a regular basis, and stuff like that. Even in sort of more professional family offices. So connecting with them is different kettle of fish from your sports star who's made a lot of money and will take a decision in 3 weeks.
And what are I think Andrew mentioned on your LinkedIn that you have very interesting experiences to share around fundraising. some stories.
Did I?
Yes.
I don't know what they were now. I'm blank.
That's
Oh, Rob, I'm sure.
I said much more than you now.
It's terribly interesting. Yeah, just mining a lot. I mean, LinkedIn's one of the best places. LPs are all there, and I'm surprised, the responses you get, the feedback you get from people is quite high sometimes. It always shocks me. Even cold connections sometimes work. I guess we want hustling LPs as much as we get hustled. Because like as a venture person, you're getting 10, 20 requests a day from random people. But it works.
Yeah, I mean, there's probably a couple of things to say. One I think on the positive side, one is not so negative in terms, or not so positive in terms of our own experience. The second one is, we came across an LP, and there are other cases like that as well, which were, they talked the best talk and kept us away, on the mountain in Italy, and like these luxury apartments and penthouses all over the place, dressed up really nice, and they also had the sort of right amount of distance, so that they wouldn't respond to your email right away, so it'll behave like an LP would, blah blah blah. And what we didn't do was, and then we started getting much better at it, is every time a new LP conversation we get introduced or a new LP conversation starts, just go in and start doing our diligence with them, right? Use ChatGPT, use Google, whatever it is that you have to do, just to get everything that you can about them. And the lesson we learned was from this particular firm that was masquerading as an LP, and essentially were a placement agent. And it turned out in the end that one of the two partners had a massive legal problem in the US, and they moved from the US to Monaco, and actually spent a year in prison. But we didn't know that when we first started interacting with them. We wasted a fair amount of time which we shouldn't have had to. But that's just a fun story, and lots of lessons from that for us. But on the positive side, I guess, this is more, this is not a story about a specific interaction, but our first fund is domiciled in India, and it places restrictions on us to make investments in topco sitting outside India, right? Particularly when you're investing on the India-US axis because of central bank regulations. So we decided to domicile the second fund outside. But we got our second fund license back in late 2022, so nearly 3 years ago. And we did not have any LP relationships outside India. Indian LPs can't invest in blind pools outside India either. So we couldn't get the LPs that we had in the first fund. So we set up a separate vehicle in India for them, a parallel fund. But for the Dubai-based vehicle, we had to get LPs from outside, and we had almost zero relationships. It's going to take time to build those relationships. Ukraine had started in early 23. And we said, let's just step back and not get out into market, taking a, and the previous fund was tracking well, but it was 4 years in, numbers were good, but there was no DPI. So we said, let's bake the previous fund more, give it a couple of years, use this time to build the LP relationships, keep them updated on what we're doing, put a bunch of capital, our own GP commitment, into this particular fund, add a bit more to it from friends and family, and build an initial warehouse that becomes a part of the proposition that we are taking out. So we went with 10% of the total fund as GP commitment into it, and build out 1/3 of the portfolio before we started going out. And because that portfolio had 2 years running, we could actually show what progress was on those companies and how they've done, quality of the investment decisions that went on, the quality of the sourcing engine, everything that we claim about value addition. We could present those portfolio founders to speak to the LPs, blah blah blah. So we launched the fundraise only late last year, and just being patient in those first 2 years by building those relationships and driving some DPI from the previous fund as well, right? So improving our metrics, improving the quality of the proposition before we launch the fundraise. That's been super helpful for us.
Yes, thank you, Tad. Any question from the audience? Yes?
I'm just going to point out a little bit about LinkedIn. I have a very, very powerful LinkedIn database. One of the biggest problems I have is I get so many fake decks sent to me. I get hit quite a lot because of either I've gone to AI events or I've gone to different other events in the technology sector, because that's my sweet spot. Question to the panel: how do you shift through the so many requests for investment that come through on decks straight to you?
I don't. On LinkedIn, I've got at the top of my profile that says, do not send me a message, go to our website. So we get about 2,500 inbound every year, and we're a very small team. We're only like four people and 2 part-time.
Yeah.
So we do look through all of them, and we've got tools, like the stuff that's not within our, completely outside of our wheelhouse, so they're using platforms which you get a lot of now to spam us. It's a Series B, we do pre-seed, so they've now looked at our website, why should I reply to their email? So we just go straight to the bins. Stuff which is in our thesis, we respond to everything. Some automated, some personal, but anything comes through on LinkedIn, I ignore. Because it says at the top of my profile, don't send me direct LinkedIn messages, submit your deck via. So if they can't bother to do that, then why should I take the time?
So I ignore as well. I haven't mentioned that, maybe I should on my LinkedIn profile, but we ignore.
Thanks. So if I have time, I'll download it, and I have a little tool I wrote that kind of scans them and puts them in OpenAI just to give me back a summary of like, this is interesting, and same thing, just filter around. If it's off piece, like get rid of it. If a few things are interesting, at least spend time looking at it, and hopefully I respond. I try to, but it's hard to sometimes.
should probably do that.
I mean, when you're looking at so many, these opportunities coming through, right? So we actually look at about 250 a month, and again, it's a very small team, 6 people in total, so you can't do much more than that, right? And even with the 250 that we do look at during a month, we whittle it down to less than 25 just by looking at things, without spending more than 5 minutes on every one of them. So
I think also if you know what you're going to invest into, being clear on your own like guardrails and being disciplined about it, makes it a lot easier.
Yes, please.
Yeah, just out of curiosity, I'm a VC and I'm an angel investor myself, but how does sending it via the website differ to sending it over LinkedIn? It's probably the same deck, it's probably the same cover letter. Why would one prefer one channel over the other?
for us, you could
When
automate
both
it.
can be
You could
automated.
automate what comes through the website a little bit better.
Can do the same with LinkedIn as well.
You could. We haven't done that yet, but fair point.
It's just a communications channel, and I think websites are notorious for being black holes for such items, and shall I say, most respectable founders that I work with will try and find a way around the website.
Emails,
So maybe
emails,
the case that
email's a nice common denominator because
emails
we have so many
is
different
another
inboxes to follow. I
communications
can't remember
If
something,
you're
and I'll log in a month
I
later.
think if you're a conservative family, you use every bloody channel.
Yeah.
yeah, exactly.
manage all of them.
No, so for us, what works best is that we rarely invest in a company that we haven't known the founders of for a good 2 or 3 years. Right? So we'd invest, our sweet spot is $2 million for 10% of the company. Right? That's the first check. We reserve a lot of capital for follow-ons. Right? And we do concentrated portfolios with more than 50%, 60% of the capital reserved for follow-ons in the top 3 or 4 companies. But for the first checks, we put them in only if we really know the guys. And we take good 5 or 6 months to take a decision for money in the bank and start a formal conversation. But we've known the people for a good 2 years, if not more, and sometimes even helped them with the pre-seed round, not us, but connected them with other investors and stuff like that. So to know these guys, and you can do that only if you are, going back to your point, is you know exactly what you want to be investing in, you're on top of it, you have a pretty good idea of every company that shows up in the pool that you're playing in within the investment thesis. And you reach out, and a lot of it is proactive relationship building over a period of time with the founders, wherever it makes sense to do that. So our reactive piece, whether it's LinkedIn or website or emails, is a tiny, tiny fraction of what we actually invest in every quarter.
Another point worth making on sort of the art of fundraising is, I see this a lot of the time actually. If there's anyone under 30, invariably it comes across to me cold because they're young, right? But if it's someone in their 50s, I'd sooner expect them to network their way. If you see what I mean. And that's it. Because you can spend sometimes it is perhaps better to spend 30 hours a week get out in town, pressing the flesh, than it is 60 hours a week, banging out cold emails. So it becomes a lot more interesting.
Absolutely. That's such a good point for us, because we do B2B tech. The average age of founders in our portfolio is in the 40s. So at the expense of sounding ageist here, if someone is not past their 30, into their 30s, we probably not look at them. We need to have experience in the domain that they have set up their business in.
Christina, question?
Oh yeah, I have a question for you. On the personal level, what characteristics you are looking for in the founders?
It's wildly variable. I think as a common theme, they're really passionate about or they've experienced the problem they're solving. They know the problem in and out. Either they lived it or they know about it through some other work reason. I think just knowing the problem is the key thing, that they have passion for what they're fixing or working on.
And how you would measure it?
I can see it either by the career they came out of, or how they found the problem, or how they came to realize it was a problem. So it's different with each one. You kind of look and say, okay, that's plausible. They knew the problem. It was a problem for them, and that's why they're fixing it this way.
So that's one, and then that experience could be, either in that problem or they solved another problem and they did very well in solving that problem, and then they had the same amount of experience, whether it was a little or a lot, in that problem that they made a nice exit from. So experience is absolutely fundamental, right? There's nothing you can do without that. But other than that, you've got to be able to be comfortable with how the governance is going to run when the company scales. Right? And a lot of that is trying to get some sense on how much you can trust the founders. It always has to be more. For us, it's at least 2 founders, usually 3 founders. We wouldn't invest in a single founder company. So that becomes very important for us. And we pay EY to do proper detailed background checks and integrity diligence of the founders and the next level of the team.
I would say it's a sort of collision of ambition and urgency. I think that obviously lots of different types of founders, but for me they fall into very clearly 2 buckets, and one bucket you don't want to back. You get founders who are just in love with the technology, and they love running a startup, and they may even love, something to do with the problem they're solving. But unless they have a real passion to do that at scale, to impact a lot of people, then you're always going to be fighting, trying to imbue that ambition onto them yourselves. I backed one of my very first ever investments was I made the mistake where I sort of put my own as a founder ambition onto the company. The company's doing quite well, curve up to the right, but actually it turned out she just loved running this company. It was a company to do with dogs, and she loved dogs, and didn't, you know, it didn't really matter about actually being a globally dominant business. She said all the right things because she'd read the blog posts and she'd read TechCrunch, and she knows that you have to say, yeah, I'm going to be $1 billion company, but you really need to look for evidence that they're making decisions that reflect that urgency to grow. Because if you don't care about growth, and that's not what you get off on, then you're never going to win. And I think a lot of founders, you know, unless you're basically willing to throw the technology you're using out the window to solve the problem or to grow faster, then, you know, you're always going to be fighting that battle. And I think a lot of, you know, we didn't back an AI company recently, and they may well have AI that's foundational AI that's differentiated and the next big thing, but the way they pitched it and the way they talked about it was just, well, we're going to win because we're the best at doing this new type of science. And it's like, well, that's not how you win, because distribution beats product. So it's, yeah, you know, that urgency to grow, no matter what, I think has to be there, because you cannot inject that into the founder yourself. You just
Yeah,
can't.
and then there's resilience as well, right? Because the journey is not going to be smooth, however good the proposition is.
Just what I notice sometimes, founders, investors expect from founders that they should be like energetic, charismatic, and for example, we had the recent case with AI platform Natasha. Do you remember? There are like billions of dollars from Microsoft, from different companies who invested in this, and because of the CEO was so charismatic, but basically there was like no any technologies behind. And there are so many cases when there are like charming founders, but there is no technology.
You still got to do your DD.
And
I mean,
vice versa.
either way, you know, if you don't do your DD, then you know you're. But I think it's yeah. I mean, we've got it. There's a brilliant company building a new aerospace prime called Green Jets. Anmol, actually Indian, but he's very quiet, reserved, but incredibly steely. Like underneath that sort of more quiet, you know, he listens, observes, is just, you know, he's going to do this no matter what. And I think identifying that, like you said, the resilience with that ambition there is incredibly
Yeah, I mean,
important.
too much charisma, too much energy is not necessarily a good thing. So,
Thank you. Two question?
Yeah, sorry, I've got a question for all of the panelists, in fact. So coming back to one of the earlier points that you made around raising from LPs. So first is knowing and sourcing the right LPs and networking around them. And then the second part to that question is how to stay compliant with rules and regulations around solicitation, which is a really interesting topic of how you do that. So I'd love to hear from each of you of what your magic sauce, your approach is.
Will allow you to, no, let me go for what I say. There are platforms out there that allow you to will offer you appropriate regs to go into each individual European country to pitch, because they will have slightly different rules, but it's going to cost you a lot of money.
And on the other hand, I know several other VCs in London who are newish firms that are not in any way regulated, have just not filed for FCA compliance whatsoever, and they're fine too. I went through it, but there's not much. It's a Wild West.
Yeah. So I think last point is, you know, you can get everything ready to set up so that you can go and set up the fund structure ready, know what you're going to do, have the plans ready, but don't actually set any of it up, because then you can actually go into market and say, look, I'm planning a fund, and then you can fall in this grey area of like marketing rules, which it's all very grey. You need to run that line between the grey and say, well, look, we're planning a fund in future. It doesn't exist yet,
Right.
and so that can fall within marketing. But you know, that'll be
It's good useful advice.
Pamela?
Hi, my name is Pamela. I'm based in a secondary fund, and I'm an emerging manager. So my question is, do you see different risk appetites through different geographies from LPs? And if they say, hey, actually it's much easier to raise from the US, how do you actually get to meet the LPs from the other side of the world? So that's my question.
Non-US LPs are generally much more risk averse in general. I mean, for the US, the same way networking in general, just finding other managers they've done, people that know them, and kind of working backwards from that. There's no magic recipe, just again spending time, pressing the flesh, getting to US places where they're at, or finding them when they're visiting over here.
Yeah, I mean, in our experience, it's quite different. You're right. I mean, for example, we have LPs in Singapore, in Switzerland, in the UK, and in the US, and it's and in the Middle East. But they all are very different, and I'm sort of at the risk of generalizing here. Right now, given what the situation in the US is, it feels like the US has suddenly become super risk averse, and that flight to familiarity and safety, or whatever the term for that is something that we are seeing a lot more in the US than we see in Europe. Singapore or Southeast Asia is very different in the sense that there's very little capital that comes out of Asia into the rest of the world. Right? So that's it's risk averse is depending on what they don't know enough about, right? So if they don't know enough about something, that's riskier for them. The Middle East is very different in the sense that they do anything that's in the US. 70% of their investments are in the US, and the rest of it is largely in Europe, and that's it. They don't look eastward from the Middle East. So it's just different things for different people.
The challenge you have with the US is that it's just such a fantastic market to invest in. A lot of LPs will look at it and say, why don't I invest in anywhere else? I've got North America, I don't need another market. So you need to find LPs that are either diversifying for another reason. So we've had, for example, some big family offices I spoke, like DuPont, for example, huge, do a lot of investing. They were pulling money out of China recently for obvious macroeconomic, macro geopolitical reasons, and starting to divest. Didn't want to divest only back into North America, so we're starting to look at Europe. But even organizations like that can have, very little knowledge of the European market. So they came over, they met us and like 5 other funds, and then eventually came back and said, it's really interesting, but we just don't feel we know the market yet. So they're going to put a check into a European fund of funds, and then they did 2 deep tech fund investments in San Francisco. So there are a lot of quite experienced US LPs who just don't have exposure to Europe. So you need to find the ones that proactively have already decided we're going to do Europe. We've done our research. We've done our we know we want to definitely deploy some tickets, and that's back to doing your DD. Ask the questions. Otherwise, you can waste a lot of time sort of educating the market, and unless you've got an incredibly strong connection that someone's just like investing in you because of that intro, then you can probably waste a lot of time.
What I see it as well is if you have like a team member who's from the US and based there as well, that helps. And at the same time, if you have a partner which also, is kind of for the US market as well, that helps as well. So even if you're based in Europe, if you have a product which is also usable, then in the US that helps.
One last question, and the food is here. So.
Yeah, you're trying to get a sense of the flow of the market right now. You guys are all lead investors in all of your deals? You always take a lead?
Not all, 2/3 probably.
Okay, so I'm curious, in terms of family offices, some of the pension funds, increasingly doing direct investment, is that competition for you guys? Is that entering the marketplace in a significant enough degree where it starts to erode some of the deal flow?
Not at our stage. It's almost always in the follow-on rounds where there's room for them.
So 3 rounds, 2 rounds. They play.
Yeah, and family offices. I mean, family offices don't like to get into very early stage, right? So they would like a Series B or a Series C. So if anything, it's actually partnership with them as co-investments and follow-on rounds.
And you co-invest, and that's what the question really is. You co-invest with them with family offices.
Yeah, so we would only take out, we'd offer co-investment opportunities only to our LPs.
Okay.
Right? And 2, we would take the opportunities out to them only if we are going to do at least a pro rata.
Okay.
Then we won't take our dogs out for investments.
I think what the problems I have with family offices, or some wealth managements or multi-family offices, is quite often the person I'm talking to pitch my fund to actually wants my job. They don't really want to be investing in funds. A lot of them actually want to be doing my job, investing in direct. So there's always this internal pressure I feel within family offices, like to get, why should we pay your fees? I want to go and invest directly in the companies. And it seems to go through a cycle where family offices invest in them directly for a while, they all load loads of money, and they go, oh no, we need to go back to investing in funds. Then a new set of managers come in, and they'll go, no, we should do direct.
Very simple.
And we go around and around again. So I don't know.
It's just cyclical. All right.
Thank you so much. I think it was very interesting. And maybe just a couple of words to wrap up from everyone, just about fundraising and any final advices.
Just hang in there.
Yeah, just make sure that the spirits in the team stay up and there is enough cash in the bank to keep going. So those are the two main things.
Yeah, it always takes longer than you think. So, you know, if you're in it, keep going. And, yeah.
Thank you. Thanks a lot.
Thank you.